Welcome to StudyVix. Always study smart and master your future. Today, we are undertaking a mission-critical deep dive, one that will really determine your success in mastering corporate law. We're talking about the foundational chapter, the absolute bedrock of the Companies Act 2013.
It really is. For any CA intermediate student, this is about so much more than just passing an exam. Mastering the preliminary chapter, which is just Section 1 and Section 2, is completely non-negotiable for practice.
Absolutely. It's quite literally like mastering the alphabet before you can even think about writing the complex novel that is corporate compliance. We are working today with some highly detailed excerpts that lay out the complete legislative history, the precise applicability rules, and, I think most importantly, the dense, often overlooked essential definitions. These are the definitions that dictate every subsequent legal step, every compliance requirement, and every penalty provision in the entire 470 sections of the Act.
That is the perfect analogy. I couldn't have said it better. Because if you miss the fundamental nuance hidden within Section 2, you will, and I mean you will, inevitably misinterpret compliance requirements later on.
Right.
Whether you are dealing with borrowing limits in Chapter 7 or audit requirements in Chapter 10, or even just the structure of penalties, our mission today is to move past simple rote memorization.
Yes.
We need to dissect the legislative intent behind every single critical definition and understand the practical, so what the real-world impact of the Act's opening salvos.
And that's the key, isn't it? Knowing this material inside and out is your biggest shortcut to quick, accurate comprehension of the entire corporate legal framework. Okay, let's unpack the timeline first. I think understanding how a mammoth piece of legislation like this comes into force is crucial for grasping its rule-based structure.
Right.
Section 1 gives us the dates we need.
It does.
So when did the Companies Act 2013 officially begin its life?
Well, the official birth certificate, as I like to call it, is marked by two immediate linked dates in late August 2013. First, the Act received the assent of the Honorable President of India on August 29, 2013.
Right.
And then the very next day, August 30th, 2013, it was formally notified in the Official Gazette for public information. And that notification was the first crucial step, because it immediately made clear that different provisions of the Act would come into force on different dates, as appointed by the central government.
And this brings us immediately to a core concept, phased commencement, which seems central to rule-based legislation in India. It wasn't just a clean single-day flip of a switch, was it?
Not at all.
And, just from a clean legal perspective, wouldn't a single commencement date have been simpler, even if it caused a bit of temporary chaos?
It's an excellent point. You're right. From a purely theoretical standpoint, one date would be cleaner. But this Act is enormous. We're talking 470 sections plus 7 schedules. And critically, it mandates the creation of entirely new legal and administrative infrastructure. Things like the National Financial Reporting Authority, the NFRA, and the National Company Law Tribunal, or NCLT.
I see. So the infrastructure had to be built first.
Exactly. If the government had tried to implement the whole Act on one day, the necessary rules wouldn't have been ready, the regulatory bodies wouldn't exist, and the electronic filing systems would have just collapsed under the pressure. So the phasing ensures that the necessary rules and infrastructure, all that administrative plumbing, can be built before the law is actively enforced.
So practically speaking, Section 1 itself was enforced immediately on August 30th, 2013. What were the next big legislative milestones after that?
We saw 2 major blocks follow pretty quickly. First, a significant chunk of 98 sections, which dealt with various fundamental aspects, were enforced on September 12, 2013.
Okay, just a couple weeks later.
Yes. And then the major operational shift to what we might call the corporate earthquake. That happened on April 1st, 2014.
Wow.
On that day, 143 sections came into force. This included many of the core provisions affecting corporate finance and management structure.
The scale is just immense. When you look at the total structure, you've got 470 sections broken down into 29 chapters, all supported by 7 schedules. But you've emphasized repeatedly that it is fundamentally rule-based legislation. For the CA student listening, what's the practical takeaway from that structure?
The practical takeaway is one of comprehensive detail, and I can't stress this enough, mandatory cross-referencing.
Okay.
When we say rule-based, we mean that every single chapter, all 29 of them, has at least one corresponding set of detailed rules prescribed by the central government. The Act itself gives you the broad legal principles, say, a company must maintain accounts.
Right. The what?
Exactly. But the rules, For example, the company's accounts rules. 2014, they provide the operational minute details of how those accounts must be maintained, where they must be kept, and for how long. So for you, the CA inter-student, you must always study the Act alongside its rules. They're totally inseparable.
The core objectives summarized for the Act were all about improving corporate governance, simplifying regulations, and strengthening investor interests. It was really an effort to modernize Indian corporate regulation to meet global standards.
Exactly. It was a definite move away from the more bureaucratic 1956 Act towards a model that's focused on transparency, enhanced accountability, and flexibility for modern business, all while trying to ensure robust protection for minority stakeholders. Hashtag tag 1.2 extent and applicability. Section 1 in depth.
Now let's nail down the scope of the Act. Section 1 specifies the title and extent. The Act is the Companies Act 2013, and it extends to the whole of India. That's simple enough. But that commencement detail, I think it needs reiterating for maximum clarity on the timing.
It's a vital distinction to make. Because we had this phased commencement, here is the critical legal interpretation point for you. When subsequent provisions came into force on different dates, any reference within any specific provision to the commencement of this Act, well, that must be construed as a reference to the coming into force of that specific provision.
So not a single universal start date for the whole Act?
Not at all. For example, if Section 125, which is the unpaid dividend account, came into force on a different date than Section 100 on calling an EGM, then for the purposes of Section 125, commencement of the Act means the date Section 125 was notified. You can't just assume commencement means the August 30th, 2013 notification date for all 470 sections.
Got it.
You always have to check the notification date for the relevant section you were analyzing.
That level of detail is precisely why this deep dive is so necessary. Now, where does this Act actually apply? The sources detail 6 key categories, starting, logically, with companies incorporated under this Act or any previous company law.
Yes, and this is the continuity clause. It basically sweeps in every existing company. Take example 1 from our material. ABC Ltd. was incorporated in 1972 under the Companies Act 1956. Despite being decades old, ABC Ltd. is now fully and comprehensively governed by the Companies Act 2013.
So it ensures no corporate entity escapes the modernized regulatory framework just because of its age.
Exactly. This definition of company is comprehensive, as Section 220 confirms a little later on.
Okay, the next 3 categories deal with these highly regulated sectors: insurance, banking, and electricity. And they all contain a critically important legal caveat. Let's start with insurance companies.
So the Act applies to insurance companies, but there's a huge proviso. The provisions of the Companies Act 2013 must not be inconsistent with the provisions of their specialized acts.
And those are?
The Insurance Act 1938, or the Insurance Regulatory and Development Authority Act of 1999, the IRDA Act.
What does that inconsistency check really mean in practice?
It invokes the legal doctrine of lex specialis derogat legi generali.
The special law overrides the general law.
Precisely. If the Companies Act has a general rule, let's say about the qualifications of a director, but the IRDA Act has a stricter, more specific rule for directors of insurance companies, the IRDA Act prevails. So where there is a clear clash, a direct inconsistency, the Specialized Act will always take precedence.
And I'm guessing that same powerful legal logic applies to banking and electricity companies.
Exactly the same. For banking companies, the Companies Act 2013 applies unless it's inconsistent with the Banking Regulation Act 1949. You can imagine a scenario, right? The Companies Act requires certain disclosure formats for subsidiaries, but the Banking Regulation Act might mandate a specific, stricter format for bank subsidiaries to maintain prudential oversight.
In which case, the BR Act dictates the format.
Yes. And similarly, for companies engaged in the generation or supply of electricity, the Companies Act is always subject to consistency with the Electricity Act 2003. It's a systemic recognition that, sectoral expertise has to trump general corporate law sometimes.
The 5th category acts as a sort of broad sweep. Any company governed by a special act.
It does. If a company is created and governed by its own special statute, say the Life Insurance Corporation Act of 1956, then the Companies Act 2013 will apply only to the extent that its provisions are not inconsistent with that governing special act.
So it ensures the foundational legislation that created the entity isn't accidentally undermined.
Perfect way to put it.
And finally, the 6th category gives the central government significant power to future-proof the act's reach.
It really does. This clause allows the government to bring such body corporate, incorporated by any act for the time being in force, as the central government may, by notification, specify. This provides crucial flexibility to bring other statutory bodies or government-created corporations under the compliance fold of the Companies Act, 2013, maybe to harmonize reporting standards, subject to any conditions the government wants to impose in the notification itself.
Okay, so if Section 1 is the legislative map that shows us where the law applies, then Section 2 is the essential dictionary that provides the vocabulary for the entire statute. For our learner who's dealing with endless section numbers, what is the actual legal significance of Section 2?
Section 2 is, legally speaking, the definitional section, and it is the single most important internal aid to construction.
Okay, what does that mean?
It means it's fundamental to how any other section of the Act must be read and understood. If a word or a phrase is defined here, say director or net worth, that definition is the meaning you must attach to it throughout the entire statute, unless it's explicitly contradicted later. Hashtag 2.1, the rules of interpretation.
But there is a huge caveat, a 5-word phrase right at the very beginning of Section 2, which I think every student has to etch into their mind the phrase, unless the context otherwise requires. Let's spend a minute on why those 5 words are just so important.
They are absolutely critical because they introduce the principle of legal interpretation flexibility. It prevents the law from becoming too rigid or, leading to absurd outcomes. It means the definition that's provided in Section 2 is the default meaning. It's mandatory unless the context, the surrounding text, the specific purpose of that particular section, or the overall intent of the provision demands a different interpretation.
Could you give us a quick hypothetical of when context might override a definition?
Certainly. Imagine a section dealing with the qualification of an independent director. And let's say the definition of relative in Section 277 would technically include an independent contractor's spouse.
Okay.
If applying that Section 2 definition of relative in the context of independent director qualifications would defeat the whole spirit of independence and just cause an absurd outcome.
Right.
A court might argue that, for this specific context, the standard definition is suspended in favor of legislative intent.
So the context is king.
The context is king. You must always start with the Section 2 definition, but you have to be prepared to challenge it if the result is illogical or contradictory. Hashtag 2.2 definitions related to corporate standards, accounting and auditing.
Let's turn to the standards that govern the CA profession itself, starting with accounting standards, which must be read alongside Section 133. We need to detail the precise authority chain for prescribing these standards. Who says what?
It's a very modern 3-stage authority chain, and it really demonstrates the collaboration between the government and the professional body. First, the central government, or CG, prescribes the standards or any addendums.
Okay.
Second, this prescription is made as recommended by the Institute of Chartered Accountants of India, ICAI. And third, this whole process happens in consultation with and after examination of the recommendations made by the National Financial Reporting Authority, NFRA.
So ICAI initiates the recommendation based on professional need, NFRA provides the oversight in technical examination, and then the CG provides the statutory teeth through a notification.
That's it. This structure formalized the oversight role of the NFRA, which is crucial. And remember the dates. NFRA itself wasn't constituted instantly.
Right.
The central government formally appointed October 1st, 2018 as the date of the constitution of the National Financial Reporting Authority. That's when this final check in the chain was established.
What about the transitional provisions? I assume those were necessary while the CG was finalizing the new standards for the 2013 Act era.
A critical transitional safeguard. Until the new standards were formally specified by the CG under Section 133, the existing standards of accounting specified under the old Companies Act, 1956, were deemed to be the valid accounting standards.
So that ensured companies were never operating in a legal vacuum.
Precisely. Never a gap in their fundamental accounting obligations.
Now, auditing standards is the authority chain identical?
Yes, the architecture is exactly the same, linked to Section 143.10. The CG prescribes standards as recommended by ICI after consulting with and examining recommendations by NFRA. And just like before, a transitional provision applied. Until new auditing standards were formally notified, the standards specified by the ICI were deemed the operative auditing standards.
Okay, let's move to Books of Account 213. This definition outlines 4 mandatory contents. This isn't just about having a ledger. The law is very specific about what must be recorded.
The definition mandates 4 crucial categories of contents. First, all sums of money received and expended, and the particulars of those transactions.
Standard stuff.
Second, all sales and purchases of goods and services. Third, the assets and liabilities of the company. And critically, the fourth element is items of cost, as may be prescribed under Section 148.
That specific link to Section 148 is key for the CA student.
And absolutely. Section 148 deals with cost audit authorization. So if a company falls into the category requiring cost record maintenance or a cost audit, the books of account definition mandates the inclusion of those cost items. It's a great example of the integrated nature of the Act. A simple definition in Section 2 points you directly to a specialized compliance requirement much later in the Act.
We also have the abridged prospectus.
An abridged prospectus is simply a summary document designed to give investors the necessary information quickly. It means a memorandum containing the salient features of a full prospectus, as specifically detailed and regulated by the Securities and Exchange Board of India (SEBI) through their regulations. It just facilitates speedy dissemination of key investment information without overwhelming the investor with the full, dense prospectus. Hashtag 2.3 definitions related to management and personnel. KMP directors, officers.
Okay, we're transitioning from standards to personnel. This is the realm of human responsibility. Let's start with key managerial personnel, or KMP. Why did the legislature even formalize this list?
The formalization of KMP was really a response to corporate failures, where accountability would often get diffused through these complex management structures. So the law identifies these specific roles because they hold fiduciary or operational control over the entire entity, making them prime candidates for accountability and compliance obligations.
Tell us the core 5 explicit categories that are mandatory KMP.
Okay, the mandatory 5 are, first, the Chief Executive Officer, CEO, the Managing Director, MD, or the manager. This is an or situation. Usually only one of these roles will exist in a company.
Right.
Second, the Company Secretary, CS. Third, the Whole-Time Director, WTD. Fourth, the Chief Financial Officer, CFO. And fifth, a designated officer who is not more than one level below the directors, who is in whole-time employment and is specifically designated as KMP by the board.
And there's that final catch-all category, such other officer as may be prescribed, which you mentioned is currently empty?
That's right. For now, the focus remains on those primary 5 functional roles. And you need to remember, while CEO 218 and CFO 219 have simple definitions, basically an officer designated as such, they must be read with this KMP list.
Why is that?
Because KMP status triggers specific, very heavy compliance and disclosure requirements later in the Act, particularly around things like related party transactions and loans.
Okay, let's zoom in on the Managing Director, MD. The core idea here seems to be the entrustment of substantial powers of management. That word substantial feels like the legal key.
It is the absolute key. The MD is a director who has been specifically entrusted with substantial powers of management, either through the company's articles of association, a formal agreement with the company, or a specific resolution passed by the board or in the general meeting.
And before we get to defining substantial, let's just clarify the prerequisite. An individual must first be a duly appointed director of the company to be appointed as MD.
That is a firm prerequisite. You cannot bypass the formal director appointment process. Furthermore, the definition includes a crucial exclusion that clarifies what is not considered a substantial power of management. This is designed to stop routine administrative staff from accidentally acquiring MD liability.
And what are these routine administrative acts that are specifically excluded?
The list includes the power to affix the common seal to a document, the power to draw and endorse checks on the company's bank account, the power to draw and endorse negotiable instruments, or the power to sign share certificates, or direct the registration of share transfers. If a director's duties are limited to these kinds of operational, non-strategic tasks, they do not qualify as holding substantial powers of management and cannot be classified as an MD.
So this distinction prevents someone who's just signing bank documents from being saddled with all the liabilities and legal limitations that come with being an MD. That's a significant protection for operational staff.
Precisely. Substantial powers usually involve major policy decisions, strategic planning, or the sale or acquisition of significant assets decisions that fundamentally affect the destiny of the company.
Now let's move to perhaps the most liability-heavy definition, one that every CA student has to know inside out. Officer in default. Too sexy. This is what determines who exactly pays the price, who faces the penalty or imprisonment when a company defaults.
And this definition is structured to chase control and responsibility, regardless of complexity. The law anticipates that companies will try to diffuse accountability, so it provides 7 interlocking categories. The first 2 are straightforward. The whole-time director, WTD, and key managerial personnel, KMP, are always included.
Okay, but the third category addresses the lack of KMP, which I imagine is a common corporate strategy to avoid having a single point of failure.
It is, and this is the critical fallback mechanism.
Yeah.
If there is no KMP, the liability shifts. It falls first to such director or directors as specified by the board who must have given their written consent to take on that responsibility.
But what if they don't specify anyone?
If the board fails to specify anyone, then the liability defaults to all the directors.
This is where practical application, like in example 7, really comes into play. A company commits a default, say it fails to file returns for the allotment of shares. If the company has successfully avoided appointing an MD, WTD, or any KMP who is the officer in default,
all directors of the company are collectively treated as officers in default. The law ensures that liability cannot be avoided just by failing to appoint designated personnel. The buck stops with the board collectively when no specific individual has been tasked or appointed as the key manager.
Let's dissect the next 3 categories because they seem to target non-executive roles or even external influence.
They do. Category 4 covers the person charged with a specific responsibility, like maintenance or filing of accounts, who then authorizes, actively participates in, knowingly permits, or knowingly fails to prevent the default. This targets operational personnel with specific duties who are directly implicated.
And Category 5?
Category 5 is fascinating. It's for anyone whose advice the board is accustomed to act upon. This is the shadowy controller clause.
Right.
It's designed to catch external persons who, despite not holding a formal board seat, effectively run the company from behind the scenes.
But it excludes professional advice, right?
Crucially, yes. The law explicitly excludes professional advice given by a lawyer, a consultant, or a chartered accountant. The law recognizes that professional advice is necessary. It's targeting those who exert managerial decision-making control from the shadows.
Okay, and the next one?
Category 6 targets directors who are aware of a contravention. This includes every director who is aware of it, either through receipt of board proceedings, being at the meeting, or just knowing about the issue but fails to object, or who gave explicit consent or connivance. This holds non-executive directors accountable for silent complicity.
And the final category, number 7, deals specifically with capital market activities.
That's right. That category targets the external agents involved in the issue or transfer of shares. The share transfer agents, registrars, and merchant bankers to the issue or transfer. They're held responsible for defaults specific to those complex capital market activities, ensuring accountability extends beyond the company's internal structure. Hashtag TAG 2.4 definitions related to corporate finance and structure.
Shifting gears now to finance and foundational structure. We've already touched on it, but let's just revisit the simple but foundational definition of company to twin.
A company means a company incorporated under this act or under any previous company law. This definition is essential because it guarantees that every entity currently operating as a company in India is covered by the 2013 Act, regardless of when it was established. Example 3 illustrates this perfectly. Reliance Industries, incorporated back in the 70s, is fully included.
Next up, contributory 226. This is a definition tied directly to the unfortunate event of winding up, but there's a specific inclusion that often surprises students.
Yes, a contributory is defined as a person liable to contribute towards the assets of the company if it's being wound up. The surprise element is the clarification. A person holding fully paid-up shares is also considered a contributory.
But why include someone who has 0 remaining liability? What's the point?
Because the definition isn't just about liability. It's about standing and procedural rights.
Ah, I see.
Including fully paid-up shareholders ensures they have the right to participate in the winding-up proceedings, particularly if they suspect mismanagement or need to ensure a proper distribution of any surplus assets. It expands their procedural rights during liquidation.
Okay, that makes sense. Now, debenture 230 has a broad scope. It includes debenture stock, bonds, or any other instrument evidencing debt, regardless of whether it constitutes a charge on the company's assets or not. What are the key statutory exclusions here?
The law has to carve out specialized financial instruments that are already regulated by other bodies. So there are 2 key exclusions. First, instruments referred to in Chapter 3 Sub-Vig of the Reserve Bank of India Act, 1934, which deals primarily with specialized money market instruments.
And the second?
Second, such other instruments as may be prescribed by the central government in consultation with the Reserve Bank of India. This just prevents conflicting jurisdiction between the Ministry of Corporate Affairs and the RBI over financial market regulation.
Let's briefly look at capital definitions. Issued capital 250 is the capital issued by the company from time to time for subscription. This takes us back to that hierarchical structure of a company's capitalization.
And understanding this structure is paramount for analyzing financial statements and compliance later on. The hierarchy is key. You have authorized capital, which is the maximum the company can issue. Then issued capital, what the company offers for subscription. Followed by subscribed capital, what investors agree to buy.
Right.
Then called up capital, which is what the company demands payment for. And finally, paid up capital, what the company actually receives.
And the numerical example really clarifies this.
It does. If a company has authorized capital of 2 crore but only subscribed capital of 1 crore, the issued capital might only be 70 lakh. From that, maybe only 56 lakh is called up capital. If there are some calls in arrears, the paid up capital might be slightly less, say $55,052,000. These definitions are crucial because so many compliance thresholds, like for small company status or net worth, are tied specifically to paid up capital.
We can now use these foundational definitions to start classifying companies. This is where the legal rubber really meets the road, because categorization dictates the difference between heavy and light compliance. Let's start with the government company, GC 245. The test is the 51% rule, but it's 51% of what, precisely?
The test is very precise. Not less than 51% of the paid-up share capital. And this 51% threshold must be met by holding from the central government or by any state government or governments, or partly by the central and partly by one or more state governments.
But what if the company has issued shares with differential voting rights? The test then switches from paid-up share capital to total voting power. Why the shift?
Because control has to be the decisive factor, not just the nominal financial investment.
Makes sense.
If €100 worth of shares gives the government 60% of the voting rights, then that company is controlled by the government. The law is designed to capture economic and political control, which is why the metric shifts based on the capital structure.
And we also have to include a subsidiary of such a government company in this definition. So if a GC holds 51% of a private company, that private company automatically inherits the GC status.
That's the inclusion clause,
Yeah.
crucial for indirect control. Now let's look closely at example 5, because this is where a single percentage point can change the entire regulatory universe. X Industries Ltd. has central government holding 25%, the government of Maharashtra holding 10%, and a combined CG Rajasthan holding of 15%. Total government holding is 50%. Is X Industries a government company?
Well, intuitively, you might say yes, 50% is parity, but legally, no, it's not. It fails the test because the threshold is not less than 51%.
Exactly. That single percentage point deficit means X Industries Ltd. is treated as a normal, non-government company.
And the implications of that are staggering.
They are. A GC has special rules for appointing auditors, for filing reports with the CAG, and parliamentary reporting requirements. X Industries Ltd. avoids that entire layer of regulation simply by falling short of 51%. Precision matters immensely here. Hashtag 3.1 government, listed, and other company types.
Moving on to the listed company, 252. The primary definition is quite broad. A company is listed if any of its securities are listed on any recognized stock exchange.
The definition is indeed broad, but the exceptions provided in Rule 2A of the definition's rules are absolutely vital, particularly for companies that might only list debt instruments. The law wants to differentiate between large, publicly traded companies and those simply accessing the debt markets.
So can you detail those critical statutory exclusions? Who is not considered a listed company, even though they have some securities listed?
Right. There are 3 key exclusions carved out of the definition for the purpose of the 2013 Act's compliance requirements. First, public companies that have listed only specific, less common securities. Things like non-convertible debt securities or non-convertible redeemable preference shares, where these were issued on a private placement basis as per SEBI regulations.
So the key is that their core equity remains unlisted.
Yes, and they're not engaging with the general public for these instruments. Second, private companies that have listed only their non-convertible debt securities, again, issued on a private placement basis. And third, public companies whose equity shares are listed only on a stock exchange in a specified foreign jurisdiction. The Act is targeting those companies whose primary equity is publicly traded on domestic recognized exchanges for the purpose of triggering major compliance like SEBI listing regulations.
Next, the small company, SC. This classification offers immense compliance benefits, lighter board requirements, easier filing, and so on, but you have to pass a very specific dual quantitative test.
The test is strict, and you must satisfy both criteria simultaneously. First, the paid-up capital shall not exceed where your crores. And second, the turnover during the immediately preceding financial year shall not exceed 40 crore. And both of these limits are set via rules and are subject to change by the government.
Okay, let's use the MMP private Ltd scenario. MMP has a paid-up capital of 2 crore, so it meets the capital criteria. But if its turnover is 60 crore, can it be a small company?
No. Even though the capital is well below the 4 crore limit, the turnover exceeds the 40 crore limit. And since the provisions require both criteria to be met, MNP Ltd cannot avail the status. It has to comply with the full rigor of the Act.
And conversely, if the capital was 4.1 crore but turnover was 10 crore, it would also fail on the capital limit.
Correct. Both must be met.
Now, beyond the thresholds, we have mandatory exclusions. What 3 categories can never be small companies, regardless of how tiny their capital or turnover is?
These exclusions are based on the nature of the entity or its relationship structure. First, a holding company or a subsidiary company. If a company has a controlling parent, it cannot claim small company status. Example 11 illustrates this well.
Right.
Second, a company registered under Section 8, so not-for-profit companies.
Yeah.
And third, a company or body corporate governed by any special act. These categories are excluded because of their fiduciary nature, public interest, or the complexity of their structure, which just necessitates full compliance.
Finally, the private company, 268. It is defined by the restrictions that must be contained in its Articles of Association.
The articles must contain 2 essential restrictions. First, they must restrict the right to transfer its shares. That's a foundational idea of a closed company. And second, they must limit the number of its members to 200, excluding one-person companies. This is the definition of a private, closed, closely held commercial entity.
And the rules for counting those 200 members are vital, especially for the conversion calculation we'll do in a bit.
There are 3 critical counting rules, and they're designed to simplify compliance and acknowledge practical reality. First, where 2 or more persons hold shares jointly, they count as a single member.
1 unit.
Yes. Second, persons who are currently in the employment of the company who are also members are excluded from the 200 limit.
Okay.
And third, persons who were formerly in the employment of the company were members during that employment and have continued to be members after the employment ceased are also excluded. Hashtag 3.2 net worth and reserves.
We move now to the calculation of net worth. This is a technical calculation, but it underpins countless statutory thresholds, from determining if a company must undertake a mandatory CSR to calculating limits on borrowing and guarantees. We need the precise formula.
Okay, net worth is calculated as the aggregate of paid-up share capital plus all reserves created out of profits plus securities premium account plus the debit or credit balance of the profit and loss account. That's the foundation.
Okay.
From that aggregate, you must then deduct 3 specific items: the aggregate value of accumulated losses, deferred expenditure, and miscellaneous expenditure not written off.
That seems like a fairly standard accounting concept of equity, but the Act introduces these crucial, non-negotiable exclusions that prevent inflating net worth using accounting adjustments that aren't realized or stable. Why is the law so skeptical of certain reserves?
The law is highly skeptical of reserves that are based on estimates, subjective valuation, or temporary accounting gains rather than realized, distributable profits. This is the most crucial part for you as a CA student and for any auditor. Net worth explicitly does not include reserves created out of revaluation of assets, write-back of depreciation, and reserves arising from amalgamation.
This skepticism is perfectly demonstrated by example 6. A company fair valued its property, plant, and equipment, its PPE upwards, and the resulting revaluation surplus was mistakenly taken to retained earnings. Should the statutory auditors include that gain in the net worth for statutory calculation purposes?
Absolutely not, and the auditor must correct this calculation. Even if the company booked the fair valuation surplus into retained earnings or any other general reserve title, the nature of that credit is a reserve created out of revaluation of assets.
So you look past the name of the account.
You have to. Since Section 257 specifically excludes such reserves, the auditors must look past the book title and ensure that the credit is excluded from the net worth calculation. Failing to do so could lead to the company triggering unintended compliance obligations based on a falsely inflated net worth.
Let's link this quickly to free reserves, 243, as this is so closely linked to dividend policy.
It is. Free reserves are those reserves, as per the latest audited balance sheet, that are legally available for distribution as dividend. And the law clarifies what shall not be treated as free reserves, mirroring the net worth exclusions to prevent payouts based on paper gains.
What are the exclusions?
The exclusions are, first, any amount representing unrealized gains, notional gains, or reserves from revaluation of assets. And second, any change in the carrying amount of an asset or liability recognized in equity like a surplus resulting from measuring an asset or liability at fair value. This strict legal definition ensures that companies can only declare dividends from genuine, realized profits.
Now we move into the corporate network. These definitions of control in relationship dictate mandatory consolidation, disclosure requirements, and the handling of related party transactions. Let's start with control.
Control is an inclusive definition, which means the law captures broad mechanisms of influence. It includes two major avenues. First, the right to appoint the majority of the directors. Or, second, the right to control management or policy decisions. And this is significant because the control can be exercised individually or in concert, directly or indirectly, through all sorts of instruments, be it shareholding, management rights, shareholders' agreements, or voting agreements. Since it's inclusive, the law allows a regulatory body to look beyond formal ownership percentages and examine practical dominance.
This concept of control flows directly into the definition of a subsidiary company, 287. What are the two tests for a holding company relationship?
A company is a subsidiary if the holding company either controls the composition of its board of directors or exercises or controls more than 1/2, so over 50%, of the total voting power. And that voting power calculation includes what the holding company controls alone or together with its own other subsidiaries, ensuring indirect control is fully captured.
Then we have the associate company, 26, which falls short of subsidiary status but indicates a significant connection based on significant influence.
Significant influence is the key threshold here. It's defined as control of at least 20% of the total voting power, or control of or participation in business decisions under an agreement. And importantly, an associate company specifically includes a joint venture company, or JVC, which is an arrangement where parties with joint control have rights to the net assets of that arrangement.
And there's a vital clarification regarding shares held in a fiduciary capacity.
Yes. The law prevents accidental relationships. Shares held by a company in another company in a fiduciary capacity, meaning held in trust for another party like a retirement fund, shall not be counted for the purpose of determining the associate relationship.
Why not?
Because the law is looking for beneficial interest or direct managerial influence, not temporary or trusteeship arrangements. Hashtag tag 4.2 related party and relative.
To define a related party, 276, we first need the underlying concept of a relative. The definition is formal and very specific.
It is. The definition is structured around three main groups: members of a Hindu undivided family, HUF, a husband and wife, or persons related in the prescribed manner. For statutory compliance, that prescribed manner list is what you need to memorize.
And Rule 4 provides the full list of prescribed relations, which encompasses 8 specific categories, ensuring all essential family connections are covered, including step relation.
The list is father or stepfather, mother or stepmother, son or stepson, son's wife, daughter, daughter's husband, brother or stepbrother, and sister or stepsister.
So if a director's sister-in-law, which is their brother's wife, isn't on this list,
she is not a relative for the purposes of the Act, but a director's stepfather is a relative. It's that specific.
Finally, the sprawling definition of related party, 276. This list is designed to capture every possible link, which leads to extensive disclosure requirements under Section 188.
The list is very extensive. It includes directors and their relatives, KMPs and their relatives. It covers any firm where a director, manager, or relative is a partner, or a private company where a director or manager or relative is a member or director. It even extends to public companies where a director or manager, along with their relatives, holds more than 2% of the paid-up share capital.
It's a wide net.
A very wide net. We also include entities whose boards are accustomed to acting on the advice of a director or manager. And crucially, a director or KMP of the holding company or their relative is also deemed a related party with reference to the specific company you're assessing.
This brings us to a critical high-yield exam point regarding Section 188, related party transactions. There is a specific exemption for private companies.
Yes, and this requires deep cross-referencing. Clause 8 of Section 276 states that an investing company, an associate company, or a subsidiary company is a related party.
Okay.
However, a specific notification grants an exemption. This Clause 8 shall not apply with respect to Section 188 to a private company.
Let's use example nutting to illustrate the trap this exemption can create. XYZ PVT Ltd has 2 subsidiaries, Y PVT Ltd and Z PVT Ltd. Based on their subsidiary relationship, Y and Z are related parties under Section 276. How did the exemption affect them?
Since Y and Z are private companies, the exemption applies. This means they are not related parties for the purpose of Section 188 transactions based solely on their subsidiary status under clause.
But, and this is a massive trap, they might still be related parties under a different clause.
Exactly. This shows why you have to check every single clause. If YPVT Ltd and ZPVT Ltd happen to have common directors, they will still be deemed related parties under clause of Section 276, which deals with private companies having common directors or members.
So the exemption removes one path to being a related party, but leaves all the others open.
Precisely. That is the complexity you must master.
Okay, let's pull all these threads together with a conversion scenario. This is a staple test question, and it requires us to apply the member counting rules from Section 268. We have Flora Fauna Ltd, a public company with 230 members, and it wants to convert to a private company. It has to limit its membership to 200. We need to calculate the countable members.
This is the perfect application exercise. We start with a full list and systematically apply the exclusions defined in Section 268 to see who must be excluded from that 200 count.
Okay, first, we have 50 directors and their relatives. These are standard members.
Count 50. These are fully counted.
Second, 15 current employees who are members.
Rule 268BA excludes them. We do not count them, irrespective of how many shares they hold.
Okay, so that's 15 we ignore. Third, 10 former employees who became members during employment and remained members after leaving.
Rule 268B excludes them as well. The law recognizes that these individuals often hold shares as a legacy of their employment, and forcing the company to remove them would be unduly harsh.
So that's another 10 we don't count. Fourth, we have 5 couples holding shares jointly.
This invokes the joint holder rule. The proviso states that joint holders count as a single member. So 5 couples equal 5 members counted.
Got it. And finally, 145 others who are non-employee, non-director, non-joint holders.
These are fully counted.
So the total number of members that must adhere to the 200 limit is 50 directors' relatives, plus 5 joint holders, plus 145 others, which equals 200 members.
The conclusion is firm. Since the total number of counted members after applying the exclusions is exactly 200, which does not exceed the statutory maximum limit, no reduction in membership is necessary for Flora Fauna Ltd to convert to a private company. The company satisfies the numerical criterion. Hashtag 5.2, capital structure and voting power.
To finalize our look at these technical definitions, we need to revisit the concepts of control through capital, which links back to the subsidiary definition. Total voting power, 289, is the basis for determining holding subsidiary relationships.
This definition is crucial for group reporting. It means the total number of votes that may be cast on a poll at a meeting, assuming every single member or their proxy who has a right to vote is present and casts their vote. It's the theoretical maximum capacity. This is the figure against which percentages of control, like the 50% for subsidiary status or 20% for associate status, are measured.
And finally, a forward-looking definition related to employee compensation, sweat equity shares.
This definition formalizes a modern compensation tool. These are equity shares issued by a company to its directors or employees at a discount or for non-cash consideration. And critically, that non-cash consideration must be for providing their know-how, making available intellectual property rights, or providing other value additions by whatever name they are called. It's a mechanism to compensate key personnel using capital growth, rather than just cash, for their intangible contributions to the company's value. Hashtag tag outro. So we've just completed a foundational deep dive into the preliminary chapter. You should now really appreciate that sections 1 and 2 are not just a glossary. They are the architectural blueprints that dictate the compliance universe of every single company in India. That single percentage point difference in government shareholding, 50% versus 51%, changes the entire regulatory framework. It imposes special auditing and reporting requirements.
That distinction alone saves immense regulatory time and can prevent catastrophic non-compliance for professionals. Likewise, the meticulous legal structure around financial concepts like net worth, specifically excluding those reserves from revaluation or write-back of depreciation, directly influences vital financial decisions.
It does.
It determines dividend policy and triggers huge statutory requirements like mandatory CSR spending found later in Section 135 of the Act. These preliminary definitions really are the compliance trigger switches.
They are the legal levers that open up the rest of the Act. Now, for one final provocative thought for you to consider as you master this material, we talk about how the 2013 Act modernized corporate law. Reflect on the simple definition of a document,
Codes.
236.
Okay.
The definition is exhaustive. It includes summons, notices, requisitions, orders, declarations, forms, registers.
All the usual suspects.
But the critical transformative part for modern business is that it includes all these items, whether issued, sent, or kept in pursuance of this act or under any other law, maintained on paper or in electronic form.
By explicitly incorporating electronic form, right there in Section 2, the very beginning of the Act, the Companies Act 2013, fundamentally shifts the entire burden of compliance, record-keeping, maintenance, inspection, and production into the digital age from the very first page.
Exactly. Every piece of corporate communication, every board minute, every single record is now subject to this strict legal interpretation.
Which means digital hygiene and data security are no longer just IT functions. They are core legal necessities for every company.
That is the essence of 21st century corporate law.
And a perfect place to end. Remember this essential interconnectedness as you move forward. Every definition you've learned today is a key that unlocks an entire chapter of compliance later on.
Always study smart and master your future. We'll catch you on the next deep dive.